things have changed so drastically in the past couple months. Like, is the world ending?
No, the world's not ending.
Like maybe in some parts of Canada or some parts of the world?
No.
No? We're good?
We're good.
Okay.
We're good.
Thank God. So welcome to a Cleancut real estate podcast here. We're putting this out there. I'm recording some videos just to meet more people. So if you have any questions about real estate investing, construction, mortgages, obviously talk to Derek with Renovate. And we want to dive into what's happening with the market and interest rates and lending rates. There's a bunch of different types of mortgages out there, so it can get super confusing. And do you know why it can get super confusing, Derek?
Because nobody's explaining it to people?
Yeah, because we go to school and we learn about parallelograms in school, and we don't learn about mortgages and down payments and amortization and all that stuff that we actually need to know in life. So do you want to just give yourself a little plug here of who you are, what you do, and who you're looking to connect with through this?
Yeah, absolutely. Derek Sparrow, a mortgage broker with Innovative Mortgage Solutions. I go by the Sneakerhead Mortgage Broker, helping you find the right mortgage. Not the lowest rate mortgage, the right mortgage. Because we're looking at all the variables. We need to get everything right for you. It's not a one-size-fits-all when it comes to mortgages.
That's where the shoes comes in.
Yeah, that's right.
Actually, or no?
No,
That should be a thing. Like,
I could use that now.
One size fit. I don't know. I was trying to figure out the connection with the sneakers. It's just because you're a sneakerhead, right?
Yeah, big sneakerhead.
What are you wearing?
Air Jordan 6 Olympics.
Are those good?
Yeah. The ones that the ones
like
that Ray
Kanye
Allen
has those?
I don't know about Kanye, but these were Ray Allen shoes when they won the Olympics in 2006.
Wow.
Yeah. Or maybe it was 2002, but anyways.
Cool.
Yeah. There's a wide variety of what we can do, whether that's a purchase, refinance, renewal, whether it's for a second home or a rental property, lake lot, cottage. Like, the product line is endless. The possibilities are endless, whether you're looking to pull out some equity, pay out some debts, just looking to get the best fit for you. That's what I'm here to do.
Okay, so I have the questions of like what type of mortgage is best for this type of person, which I know that's very like depends on this situation, but we'll kind of go over that generally.
Yep.
Before we do, I wanted to ask you what your thoughts on the interest rate hikes. Like, things have changed so drastically in the past couple months. Like, is the world ending?
No, the world's not ending.
Like maybe in some parts of Canada or some parts of the world?
No,
we're good.
We're good.
Okay.
We're good.
Thank God.
I know. I've got the crystal ball. I've seen.
Yeah.
No, while it's shocking, these rates aren't historically low, but when you're comparing them to pandemic rates, when people were getting 1.59 for a fixed rate, now they're looking at 5. Okay, like, yeah, it seems shocking, but that was not a regular time.
Yeah.
So it's tough to compare. Mm-hmm. And like, I don't think that it's going back to 18% like some people are worried about.
18? No.
Like,
the government would just collapse.
Yeah.
The banks would just, everyone would hand in their keys. I think my dad was telling me about when they bought their first home, they called them like dollar mortgages because people were just buying out mortgages for $1.
Yeah.
And I think the banks and the government have kind of learned their lesson from history of being like, well, we don't want everyone defaulting on their mortgages and handing in their keys. So
right.
I think there is like some play there. And they're not going to repeat history for some stuff. But I know in the real estate world, for me, like, since the rate hikes, everything's definitely slowed down. But like you were saying, it's just because we were seeing like record numbers. So we were having like record sales in real estate, pushing out tons of construction projects, and people are buying rental properties left, right, and center. Mm-hmm. People are refinancing and going crazy with that lending rate. And now it's not that like the world is blowing up. It's just that things have slowed down a bit. And I actually hope that some house prices come down a bit, like that they're just reasonable.
Yep.
But the thing that I think of is like all you people in BC and Ontario, like I feel for you guys because Alberta's like pretty flat. Like we'll get little hills and valleys, but we stay pretty steady. But if we were in a different province or certain places in the U.S., I think we would see more drastic changes in our market. So I think it's just going to slow things down a bit, which is healthy. But what are you seeing on the mortgage side?
Well, what's been happening is it's pricing people out of certain homes, right? So like now you might not be looking at a detached single family. You might be looking at a townhouse or a condo. With these rate hikes. There's also is the element of us having to get you in the door sometimes with a variable rate, like fixed rate just isn't an option. Because when we're qualifying a borrower, we have to qualify them off of the Bank of Canada rate or their rate plus 2%.
Right. So
if the fixed rate is at 5 and the variable rate's at 4.2, we on a fixed rate of 5, we have to qualify you off of 7 instead of 6.2. So there's potential there to gain back a little bit of buying power, but it's just one of those different variables. Like we can look at everything and make sure it's the right fit, but sometimes at the end of the day, it's like the need to just get in the door. Like if you want this property, here's what we have to do because of this. Yeah.
I saw like a couple memes on Instagram of being like, my husband breeds salamanders and I, what was it? It's like I catch butterflies and we got approved for $1.2 million. So I think it's more so that we're getting to like realistic expectations of, no, you can't go buy that $1 million property anymore. And so
there probably also should have been discussions with people of like, do you want to be like that tight on,
it's a healthy conversation. So you don't want to be like driving a Cadillac and in your like $1 million mansion and like not missed one paycheck and then have to hand in the keys on all that stuff. But again, just a bit of education that we're not taught in school, which is too bad. Or most schools. So the lesson can be learned now through your real estate and mortgage specialist.
That's right.
I know you are a huge advocate not to just get someone into a mortgage with the lowest rate out there, but to actually look deeper into what are you trying to accomplish with this mortgage. I know when my wife, Janelle, when she bought her first home, she got into a mortgage, just went into a bank. They're like, fantastic rate. You're a nurse, so easily approved. Sign here, go buy a house, move on. When we got engaged, we wanted to start looking at buying a home together. And to get out of her mortgage was, I want to say like an $18,000 mortgage penalty. And she had no idea. So that went from like us buying this exciting, dream home together per se, to us having to rent the property for a year and a half, almost 2 years, and still having to pay a pretty hefty mortgage penalty to move on from that mortgage. And it was just because, she's like a lot of first-time home buyers that go in and is like, give me that low rate. Rates are so low. Give me the lowest rate and make my payments low. But you could pay for it later. Or it could change life down the road.
Almost everybody comes in looking for the lowest rate because that's what gets put out there that you should get, the lowest rate. But then hopefully through the conversation, there's future analysis and what's going to actually work best for them right now. Because there's so many different variables to consider, whether you're looking at fixed versus variable or extended amortization or term. And we want to make sure that it really fits with that person's life right now as well as in the future. They say that I think 60% of people break their mortgage before the term is done. And so they're moving constantly.
60% of people are breaking their mortgage terms
before the term is done.
I've heard that like over the course of time, if you look at like long-term situations with variable rates, that variable actually wins. Like
historically, more
most
savings.
of the time, yeah, you're going to save more money. So why are most people going with fixed?
I think there's like
fear.
I think fear is a huge part, but I also think that there's an element of them not understanding how the variable works. And when they find out, generally it's like, oh, I didn't know that. Or like my uncle told me that it can shoot up 6% overnight. And it's a little bit more structured, right? And so it'd be something along the lines of, say, prime -1. And so that -1 stays the same the whole term, and prime is what has potential to change.
Right.
And they have 8 meetings a year to determine what to do with the overnight lending rate, which affects prime.
Right.
And so those meetings are structured. They're set. Like, you can anticipate when those meetings are coming. It's not like a random Thursday. They're just like, all right, rates are going up 4% tomorrow, which some people thought that was possible. And then there's also, they're less risk averse.
Right.
And so they don't want to take that. They want to set it and forget it.
Yeah.
But I do think that when many people hear how many benefits and how much freedom the variable rate gives, they generally lean towards that.
Yeah.
Because if for whatever reason you don't like the variable rate, you can lock in to your lender's fixed rate, penalty free, at any point in the term.
Hey, that's good to know.
But the big thing is the penalty.
That's the biggest benefit?
Like whether you broke the mortgage on week 1 or year 4, that penalty stays the same. It's a 3-month interest penalty, and like,
it's reasonable.
Yeah, it's very reasonable.
Yeah.
And there's also an element with variable rate of riding the wave. Like, there'll be times where it's higher, where it's lower.
Yeah.
That's all part of it.
Yeah.
One key thing that I like to advise people who haven't gone into a variable rate is to write down the fixed rate and the fixed rate payment that they would have started with, and keep it close, so that when you see changes, you can reference that old number and still see that you're making savings.
Right.
Because if there's a $300 difference between the two right now and your rate goes up $50, you probably will panic, because people get used to the lower payment amount.
Right.
But if you can say like, oh, I'm still $250 ahead, then it's like, oh, okay. Like, it would have to go up how many more times for it to even just match the fixed rate.
Right.
So
yeah, that's huge. Like, I think a big thing, like I was kind of commenting on before, is when people get into rental properties, like Edmonton at one point was known as like cash flow capital. Like, come here for the cash flow in your rental property, and they want to maximize that cash flow, which means get me the lowest rate. The hard part is like, like not too long ago when we saw those spikes in home prices, and then people are coming to me being like, hey, it's a good time to sell. So then we go look at the numbers to sell their home, and they can get a premium for that sale, but their mortgage is holding them back because they locked in at that rate. And now, kind of like to my story with my wife buying her first home, it's like $20,000 to get out of this mortgage, like, can't sell, and then they're stuck holding it for a longer time. And then if they hold and like miss that point of when house prices are up, you could be losing however much more money when the market comes down. So I like the idea of having total control of when I can sell and move on from my house. And that's why I'm more of a variable advocate. Yeah.
People need to look into the future more. There's too much of just get this now, but like really look at what the future looks like for you. Yeah. Like, are you going to stay in this home for long term? Are you actually going to keep it for long term? Or are you just saying that to move the conversation along? Yeah. Because we don't want you to have that huge penalty. Yeah.
No, I hear you. Okay. I'm going to jump into some of these questions now of what is the right mortgage, because I know that's kind of your Instagram. This guy's so good at Instagram and social media stuff. And yeah, you got to check out his Instagram. What is your handle?
Sparrow_Derek.
Okay, right on.
Yeah.
Sparrow_Derek. Check that out. You're really into, what is it, Seinfeld or something?
Oh, love Seinfeld.
Yeah,
love Seinfeld.
I've never seen any Seinfeld.
You've never seen any
no,
Seinfeld?
but I can see like your passion when you do like he does these voiceovers like of a Seinfeld line. And it's kind of like my buddies who love The Simpsons, and they'll like say the Simpsons quote. I'm like, it's not even funny. I don't get it, but I can just see like that you love it.
I do,
and then it relates to.
I have so much fun doing it. My wife doesn't like this Seinfeld part. She's like, you should stop doing those. Like somebody out there is getting it.
Oh yeah, someone's calling you because of they love Seinfeld too. Probably.
That's right.
I guess a little bit off topic, but I have quite a few friends or like follow like business podcasts, and people are like, put the minimal amount of money down on any home, like 5%, because money's free. Like the lending, like when lending was at whatever, people were getting mortgages for 1.9 or whatever, and people are going, that's free money. It's free. And that blows my mind, because it's not free. It's still like $700 of interest every month. So you think a monthly payment of $700 is free, then like you're crazy.
Yeah.
In my mind. The other thing is people are like, well, I just take like, if I have a 20% down payment, let's say, I can put 5% down on my home, and then I'm going to take the rest of that money and I'm just going to go invest it, because I'm going to make way more money than that 1 point whatever, or 2% or whatever. I'm like, okay, where are you putting it though? So if you do, like, there are legit people who know how to invest their money and put it into stocks or whatever. You want to go into crypto, you want to go into a rental property, whatever you want to do with that, put it into your business. That's fine. But like, do your due diligence to make sure that you're actually making more money than what it would cost to like pay down your house. And I think a lot of people are like, oh no, I'm only putting 5% down because I'm going to go invest the rest of their money. And then they either like blow it on a car, or they put it into crypto, and look at where crypto is right now. Like, I mean, it can be a good investment, but maybe it doesn't turn out to be that way.
Right.
Where in my mind, like your primary residence, paying that thing off, that's a huge benefit. So yeah, like as long as you're actually making more money than where you're investing that, then that's where my mindset's at. But don't say this like theoretical, like, oh, I can go make more than 2% blah blah blah.
And I'm sure that you could, but like
potentially, yeah.
Not only do you need to know where you're going to invest and make sure that it works, you actually have to follow through with that. So if you have 80 grand for a down payment, you're only going to put 20. Make sure that when we go to purchase that home, you're taking that 60 at that time and investing it.
And not, oh, I bought a $120,000 boat, so I actually got 2 mortgages, kind of.
Right.
You know what I mean?
But like a lot of people forget that insurance premium. Like, do you want to pay
CMHC?
Yeah, do you want to pay $20,000 and just add that onto your mortgage? Like,
that's a whole nother like recording we could do, is just CMHC.
Yeah.
Where that's a big math equation to see if that pays off or not. Because usually an insured mortgage with CMHC, you get a lower mortgage rate.
Lower mortgage rate, but higher mortgage.
But higher mortgage.
Yeah.
You're paying the CMHC.
It's the deceiving thing that lots of people don't understand. Yeah. Like, well, why are they getting a lower rate and they're putting less down payment? It's like, because there's an additional large amount getting added onto your mortgage.
You know what's insane? I think this is right. Correct me if I'm wrong here. I've never had CMHC on a house of mine. But I heard, like, so CMHC is an insurance policy. And insurance is there so that the mortgage, whatever, the bank, the lender, wants to make sure that if you're not making your payments, they're getting their money from somewhere. CMHC is stepping in to say, you pay us a premium, like an insurance policy, and if you default, we'll pick up the slack. The thing that I didn't realize is, like, you're paying this company a premium, and then if you default, they actually just sue you. Is that right?
I don't know. I have not heard.
You haven't heard that?
No.
Okay, so I heard that they just come after you, like, for all you're worth, and like if you're adding money anywhere. Like they're trying to get every single pay after. So I just think it's funny. Like you're paying this insurance premium, and then like you're just paying it so that they can come after you. Which I mean is insurance. It's the insurance world a bit. So, pretty crazy.
Yeah.
But definitely kind of a hidden fee there that people don't want to talk about or bring up, or really look in the face and like acknowledge that they're paying this premium. So you can educate on that. Okay, so next question I have was someone who wants to buy a rental property. So someone who's like, Nick, I see that you have some good cash flowing suited houses, which I do right now. We want to buy one.
Mm-hmm.
What most people are coming to me being like, maximize that amortization, lowest rate. We want most cash flow. What would you say?
This is actually one of the areas where we want to strategize the most and look at the future plan. Because what, as an investor, do you want specifically? Is the goal 10 houses? Is it 5 houses? Is it 20 houses? Because depending on which lender we go to, there are certain criteria that if we don't analyze that future plan, we're going to burn some good spots. And so what I mean is there's certain lenders who will only allow you to have 4 rental properties. If you try and go back to them with a 5th, declined. So there's a lot of lenders that are within that 0 to 4 range for rental properties. Then there's a couple lenders in that like 4 to 6, and then 6 to 8, and then only a couple who will allow you to have 10 rental properties. And so the strategy being that you need to go to the lenders that are in the 0 to 4 category first, and then slowly change to the other lenders who will allow you to have more.
Depending on that. Okay, cool. If someone wants to flip a house, so like fix and flip is such a like hot term right now. And it blows my mind because a couple years ago, like I was the only one flipping. I'm not going to be the only one, but I didn't see a lot of things online of people doing fix and flips. It was more so buy and hold. Now it seems like there's this like change of heart, or people are getting bored of rentals. I don't know what it is, but everyone's like, yeah, I want to make those big bucks in fix and flips. So then they're trying to buy something undervalued, put some renos into it, and then selling as fast as possible. That's where you want something that's not going to have a big mortgage penalty on the back end.
Right.
But also, like, can you get financing for your renos as well?
Well, yeah, like for the renos, there is purchase plus improvements.
Which is up to 10%, right?
Right. With possible exceptions on certain lenders.
We can explain that a little bit better. So when you buy a home, let's say it's for $300,000, then the purchase plus improvement would be money up to 10% with exceptions here and there. So $300,000 would be $30,000 tacked onto the mortgage of cash to go and do those improvements.
There's other stipulations, like it's generally or up to $40,000 caps. So it's like 10% or $40,000, the lesser of the two. But like I say, there's different lenders that have different, like might be 20% with one lender, might have.
So if you need like $150,000 to do a reno, then what are we doing?
There could be potentially one lender.
Okay.
But that's it.
But not potentially. Like you have a good.
It's just like there's only one lender who is in that scenario who has led on that they're willing to take it on. The other one would be, or the other ones would be like on exception basis. Like it would have to be the strongest file for them to.
So the biggest thing is that you still have the connections to make that happen.
Yes.
Okay.
But yeah, like if you are looking to flip, you'd obviously want to be in a variable rate, because if you don't want to be locked into a fix and pay a huge penalty.
Yeah.
But going down the standard mortgage route, you're going to run the risk that lenders aren't going to go for you because they can see the past history of you buying and flipping, and they don't make a ton of money if you're flipping a home within a few months of getting the mortgage.
So standard banks hate flippers.
Yes.
Okay, so then what?
And so then we do have a lender who is particularly great in this situation, where it's a higher interest rate, reasonably so, but you can actually put less down payment and still come out way ahead. Like they have an amazing calculator that you can plug in every single detail, and it tells you like if you're going to do all these renovations and sell within 3 months, here's your expected profit. If it goes to 4 months, here's how much you would lose. So you can really anticipate what it's going to look like and cater it to what's going to work best for you.
Yeah. So then you have access to a lender who loves flippers.
Loves them.
And like spends most of their time catering to their needs.
Yeah.
And making it so that you don't have to buy cash and like worry about those expenses.
Exactly.
They want to work with you throughout the project.
Yeah.
And they're fantastic, apparently.
Yeah.
Okay.
They are. And like they really do like this. Like they're getting into this. Like they're trying to.
They're the fix and flip mortgage lenders.
So.
But come talk to you more about that.
That's right.
Okay. Someone who wants to BRRR a home. Do you want to talk about BRRRs?
Like the buy, rehab, refinance, rent.
And repeat. Yeah.
Yeah, like there's not really. This would go back to the properties thing on the rental, right? Because if you're going to do that and repeat, like buy one home and then add 2 and then 3 and then 4 and then.
So would you say use this like flipper lender until you're at the final product and then go talk to, then you'd, the client of yours would then switch to more of a standard.
Yeah, like we could refinance them into an A lender or.
Into an A lender, yeah. So it's you're dealing with 2 different mortgages. So you're going to buy a property, hopefully undervalued, with this flipper lender, and then you're flipping to yourself. So when you sell to yourself, you're getting it you get it reappraised once it's done, and then you're flipping to an A lender. And then you can go through the process of, hey client, do you want to keep this thing for a long time? Do you want to go down the variable?
Right.
And then talking to you, you'll kind of figure out what's the best.
Yeah.
Cool. Someone who is self-employed. So I've been self-employed forever. That's just who I am. And when I was trying to get my first home, my dad sent me over to the bank and was like, oh yeah, this will be a breeze, no problem. And I was just like, no. Everyone was saying no to me because I didn't have enough history.
Yeah.
And even to this day, like I have enough history that I can show stuff, but the banks seem to prefer like dealing with someone like my wife who works for the government and they're like guaranteed income basically. For obvious reasons, they prefer that, but self-employed, need a mortgage. What do you recommend?
Well, like there's a couple lenders that come to mind depending on the situation. Like as long as we can show a solid 2-year history, we can go to basically
A lender?
Yep.
Okay.
Yep. But like we have one one particular lender that has a special product where if you only have a year of being self-employed, they'll look at it. All the other lenders like minimum 2 years.
Gotcha.
And then there's another lender who we can also add in some net sale or like net profits from their business on top of their income to help gross things up. So there is other opportunities at other lenders, but it's all about like we just need a 2-year history, unfortunately,
Right.
which is.
But like you said, you do have access to certain people who look at 1 year, or I have heard of certain scenarios where people are working for less than a year, and again, you could hook them up with a certain lender who might be a higher rate or whatever, do things differently, and it'll just get them by until they have 2-year history, and then you can flip them to an A lender, right?
Right. So there is alternative financing which offers more options at higher rates, but you need minimum 20% down payment.
Gotcha.
So there's no insured option.
Okay. And your 1 year history lender, is that 20% as well?
No, that's an A lender.
Oh, okay. That's great. So you could do 5%, or you could do whatever. Okay.
Yeah.
Someone with standard employment, so government worker.
You kind of have your pick. Like if
that's the best.
Yeah.
That's the easiest.
Yeah. Because I mean, like if it's government work, like it's so solid. Like lenders view that like gold.
Yeah.
There's no worry.
What about heat locks? I know people like it's HELOC.
A home equity line of credit.
There you go. Yeah. I think that like there's so much power to that. I don't know a ton of people who actually get one. But I don't know why. Like, I think it's, again, just people don't know about them. But maybe you can speak about, like, the power of them and really what they are.
Yeah, so it's being able to access the equity that you have in your home. And as a general rule, you can only have a HELOC up to 65% of the home's value. And you can't start to access a HELOC until you're at 20%. So... like you would have to be able to put 20% down, or if we're refinancing, you would have to at least have 20% equity to start accessing it.
Okay.
And like they do provide a lot of opportunities, right? Like it's a great safety, like to be able to have that in case something comes up, whether there's an emergency, or to be able to use to your benefit if you want to do a renovation. And if you have 60 grand on your HELOC, you can access it just like that, do your renovation, and then you could refinance if you wanted to. And
yeah, that's huge. We deal with a lot of clients who want a new kitchen, they want to renovate their house. If we give them a quote, go through the house and we're ripping out this, building this, taking out walls, blah, 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 blah. Right now with the prices of trades and lumber and whatever else, like $100,000 renovation isn't crazy anymore.
Right.
So, for someone to like save up $100 grand, put that aside, and then want to go ahead with a reno, that's like just, I don't know, it seems crazy to me, or like just a lot of people would be like, yeah, we can't do that.
Right.
So
we
the idea of a HELOC.
We have the HELOC option, but there's also a refi plus improvements.
Yeah.
Which is something different than the purchase plus improvements, right? You already own the property, you want to do some renovations, we can refinance up to the improved value and then build that in.
So I think just a lot of people don't know that they can go and call whatever, you or me or any realtor or mortgage broker, and be like, what's my house actually worth? And they're like, we bought 5 years ago or 10 years ago for $355. Oh, my home's worth $455 now. So I have $100 grand equity built in now. Just from owning the property and the power of owning real estate. I want to access that $100 grand so that we can continue on with our mortgage and kind of pay that off over 25 or 30 years. And it just makes it so much more, what's the word? Less intimidating, feasible. Like you can get a really awesome renovation done, or get your house the way that you want it to look without having to like either save up that money or sell your house and buy something different. So
the thing you have to make sure with the HELOC is that you're being proactive in paying it down. Because if you don't go above and beyond, you're just paying the minimum interest payment. Right. So
which actually could be a benefit. Too, right? You have a bit more control if you want to pay more off or not. You get whatever, some kind of bonus at your job, 20 grand, pay down the HELOC. But, our whatever car broke down, I need whatever 10 grand to get it fixed. Pull it out. So a lot of flexibility there, which is
for sure
fantastic.
And it's also something that not very many lenders offer. I shouldn't say not very many, but most lenders don't offer a HELOC versus lenders that offer a HELOC.
Right.
So something would be to take into consideration if you're doing a renewal and you have a HELOC and want to keep accessing the HELOC, we have to transfer you to a lender that also has a HELOC. So it's not necessarily the free, all options are available kind of thing.
Yeah, that kind of leads me on to like our final topic here, but the power of paying down your mortgage quicker. Which I think a lot of people, like we were talking off the start, just kind of get used to their mortgage payments and it comes out of their bank account and they have their income and just let it do its thing. And I'm going to pay my mortgage off in 25 or 30 years, whatever it is. But when you put the numbers in front of people to show, hey, if you actually put down like an extra 10 grand a year, that could pay off your mortgage you could save years.
Oh yeah.
On your mortgage. And like when I first heard of a friend buying a home, and it was like $300,000, I want to say, and then them saying, yeah, but once my mortgage is up, like I actually have to pay like $600,000 for that house, right? Because with all the interest and whatever, I was like, what are you talking about? Like, there's no way that's real. But that's just because like we weren't educated like that in school. But that's the reality of it. So it's like, I bought my house for $500,000. But it's like, no, actually, over the course of time, with all those interest payments, you're paying way, way, way more for that house. So having access to like a HELOC, a line of credit there, or being able to pay down your mortgage, those prepayment penalties, which I think that's another thing that people just don't know, that, hey, there's a cap on that. Like the lenders don't want you to necessarily like pay down that mortgage within a year or two, because then they're not making any of their money on you. So they're going to give you access to a certain amount that you can pay down. But I think a lot of people just do not even think about putting extra down every month, or at the end of the year putting down lump sum payments. So you can speak about like the power of
for sure
getting into that.
I mean, even paying down your mortgage faster, it could start with just doing accelerated payments.
Meaning?
So like instead of doing monthly or semi-monthly, like do accelerated bi-weekly. Like just by doing that and getting extra payments in every year, you could be chopping your mortgage down by 2 years or 2.5 years just by doing that. So you could shorten that life from 25 to 22 and a half just by doing that one thing. And then being able to use your prepayment privileges up to 15 or 20% or whatever lender we go to, it makes a huge difference. But I think lots of people assume that it has to be giant lump sum payments. It can be minimum $100. So you could do $100 a month and put that straight towards the principal for the entire term, and you would come out way ahead.
It can save you years.
Yeah, years.
Which is crazy.
Yeah. Crazy. Or like if you're in a position where you get yearly bonuses and you don't necessarily need that bonus, what about just taking that bonus and putting it straight down onto the mortgage?
It's kind of a set it and forget it kind of thing. Like, if you just know you're putting aside that money, then it's just gone. Like you can just kind of live your life. It's kind of like that thought of, I think Rich Dad Poor Dad talks about it, but it's like pay yourself first. Because people usually like go and live their life and then they hope that they have something left over. But it's more so like if you take it off the top, just put that extra $100 down on your mortgage. Then you're gonna live your life and just adjust. Like you'll make it work, and you'll realize, oh, it didn't actually like change my life that substantially.
I think it's not as exciting of a thing. Like if you took that bonus money and invested it, or you could see the growth, is more exciting than seeing that your mortgage is at like 20 years instead of 23.
That's like, exciting to me.
Well, I know, but not everybody's going to think like that, right? Like, I think that would be great to like all of a sudden like, oh yeah, I've only got 13 years left on my mortgage. Like that'd be a good feeling.
Well, in my mind, like my mindset, I guess, is I want to pay down like primary residence, pay that off quick, and then we're talking about HELOCs, then get like a massive line of credit. So, you know, by the time you pay off your house, let's say it's worth whatever. What's like the average home selling in like Sherwood Park? Like Edmonton's too big of a range, but let's say Sherwood Park, like average home sales is somewhere in like $550,000, $600,000. So like, you have access to quick math. What's like 80% of 600,000?
Well, no, through a HELOC, you only get 65%.
Oh, 65.
Max at 65.
Okay. But you're still getting access to hundreds of thousands of dollars that you have the control of that. Yeah, we want to go buy a boat this year. There you go. And you're going to make some interest-only payments. And then within a few years, you sell that boat. And I mean, even right now, like a boat can be people talk about it being a bad investment. But if you buy it, use it for a couple of years, the pandemic's a good example of this. Like people are selling their boats for more than they paid.
Right.
So it can actually turn into being like a good investment instead of people having like not a huge mortgage, but they have a mortgage and then they have this boat payment and then they're trying to restructure and then it's payment on payment on payment. I just like the idea of having my home paid off, free and clear, and then having access when I want to a bunch of money, which is which is really cool.
One thing I will add in is like a little bit different, but know that if you have the HELOC or have access to the HELOC, you're still technically not mortgage free because that HELOC portion is still registered on title. So if you haven't used it and later on down the road, your house went up in way more value and you wanted to refinance, we would have to remove that original HELOC off of title. And
there's a penalty to that?
Not a penalty, but you just wouldn't have access to that particular one that was registered on title. So, and not that it's a big thing, but like,
no, that is something to know.
Yeah.
That if you're looking for multiple mortgages, in my mind, it's just having a mortgage in your back pocket, like ready to go when you want.
Mm-hmm.
And like as a flipper, I love that because then it's like, well, I'm not just having a mortgage and waiting for an opportunity to come. It's like, I don't really have a mortgage payment until there's an opportunity to jump on. So cool idea there. Anyways, we're maxing out some time here. So yeah, thanks for the chat. The biggest thing that I'm going to take away from this, and I think you guys take away from this, is that if you go to just your, like I deal with BMO or whoever for my regular banking. So I'm going to go talk to them about a mortgage. They only have so many products that they can offer you. And like Derek was saying, if you're trying to flip a house, like they probably just don't like you and they're going to lead you down a path that just like, they'll say no, and then you'll be like, oh, I just can't do this. Or they'll get you a mortgage that isn't the right fit for your situation, where it seems like you have access to so many different products. Mm-hmm. And even if BMO or whoever else might have a lower rate and it's like trying to draw you in, it still might not be the right product for you. And you just have access to way more products than your typical bank. So huge advantage to talking to a mortgage broker like yourself. And I mean, you're just an honest, good guy that'll lead you in the right direction. So,
and like there is a conversation that we have with clients that if the rate their bank is offering is better and it still hits the prepayment privileges they want or the type of term and all of that, then go with them. But the idea is like you need to have the conversation about what is right for you.
Right.
Like that's the most important thing because then we're actually talking and trying to figure out for you specifically what it's going to be.
Fair enough. All right. So if you have any mortgage questions, reach out to Derek Sparrow with Innovative Mortgages. Phone number, email, what do you want to give?
Yeah, so you can call the office 780-416-1085.
Actually, don't call. Just add this guy on Instagram. Follow his Seinfeld stuff.
All my contacts
his
info
sneakers.
There,
You should do actually like a thing about like showing your sneakers every week or something.
Oh yeah, like the fit that I'm wearing that day.
The fit, yeah. There you go. The vibes that you're giving that day. Add him on Instagram. You can add or send him messages and go from there.
Yep.
If you have questions about real estate, construction, design, home staging, flipping houses, that's what I'm doing. My name's Nick Pentelechuk. I'm from Cleancut Real Estate. Have a fantastic day, and we'll see you on the next video.